petty cash book after doing the cash book, okay, the cash account in subsidiary books. Now we're gonna learn about bank and all things. Before starting the lesson, let's wait for 1 minute to student to join this class, for other students to join this class. And after that we will commence our lesson, okay? So tell me, have you practiced the journals? As I said, you need to practice journal entries. Have you practiced it? I'm asking something. Have you done practice of journal entries, which I said you need to do in last class?
Not yet.
You have to do practice of journal entries in order to learn new topics of this subject. Because journal entries are base of this subject. Without journal
Yes, ma'am.
entries, you won't be able to understand the next topics. So that's why I gave you homework to learn journal entries, to practice them.
We will,
You
ma'am.
need to do it. Okay. It's already 3:03. I guess we should start our class and student will join in our running class. Now, what is bank? So, bank is an organization which deals in money by accepting deposits and lending to those who needs it. Accepting deposit is the primary function of a bank. Like you go to the bank nearby your house is what their work is. What their work is to deposit your money and to lend the money who are in need. So that's the primary function of any bank. Okay. The bank also renders various other services to its customers, such as collecting the amounts due to the customer, like interest, dividends, etc., making payments on behalf of the customers, issuing letters of credit, providing travelers' checks, providing safe deposit lockers for safe custody of valuables, and tarnishing guarantee on behalf of the customers. So these all are the services which banks provide other than the depositing money. Now we have different type of banks, and the first one is here these are the different type of bank accounts, not different type of banks. These are the different types of bank accounts. The first one is saving bank. First one is saving bank. A normal person have a saving bank with their bank. Okay, they have a saving account with their bank. They just deposit their money, and at the time comes, they collect the money from the bank. That's what a saving bank is used for. The second one is current account. Current account. Current account is used by the business persons. Okay, the businessmans. Normally, it is a firm's account in which people can deposit the money, and they can transfer the money to the creditors, to the customers, or whomever they want to. Fixed deposit account. Fixed deposit account. This is a type of bank account in which people deposit their money for a long time of period. Okay, suppose you want to deposit 2 lakh rupees. You want to deposit 2 lakh rupees in the bank account. Then you have two options. You can either transfer that amount in your saving accounts, or you can do the fixed deposit account. If you want to deposit your amount, the amount of 2 lakh rupees for more than 1 year or 2 years, so you can just go with the fixed deposit account because it gives more interest rather than saving bank. The returns in deposit account, fixed deposit account, is more than the saving bank returns. Now coming to the advantages of having a bank account. Money is safe, it is also earned some interest. The bank provides various types of loan. It is easy and safe to make payments by issuing checks, or if we talk about today, then it is easy to use your uh, net banking to make payments and receive the amount in your bank account. Money can be sent or transferred to other places at a nominal charge through a bank. The bank helps in collection of bill, check, etc. on behalf of its customer. If you want to send money to a person who is situated in a different nation or different state, then it's not needed. Then you are not needed to go to that person and share the money. You can just go to your bank and transfer the money from there. So that's what having a bank account is. These are the perks of having a bank account. So bank prepare three types of account in their banks. Okay, they provide three types of account to their customer. Passbook. First is passbook. Second is a pay-in slip book. Second is a pay-in slip book, and the third one is a checkbook. Third one is a checkbook. Coming to the first one, passbook. So passbook is a copy of customer's account maintained by the bank, or in other words, it is nothing but a true copy of transactions with bank as they appear in customer's account in the bank's ledger. In the bank's ledger. So this is the format. This is the format of passbook. This is the format of passbook. You can check it here. We have different columns like date, particulars. There the debit amount is shown and here the credit amount is shown. Because it is from the perspective of customer, because it is from the perspective of customers. So in debit amount we shows withdrawal. In debit amount we shows withdrawal, and in credit side we shows deposit. Whatever a customer deposit in their bank account, then the amount will be shown here in credit side. And if we as a customer we as a customer withdraws the amount from our bank, then it will be shown here in the debit side of our passbook. And here the balance will be shown, debit or credit balance, and that's it. Coming to the pay in slip book. Pay in slip book, it contains printed forms which are used for depositing cash and checks into bank. Which is used for depositing cash and checks into bank. If you want to deposit cash, or you want to deposit check, you have received a check from someone and you want to deposit the same into your bank, then bank in that case bank will provide you a pay in slip book. That bank will provide you a pay in slip book, and you have to fulfill this. Okay, you have to fill this slip. As you can see here, it's a slip, pay slip, and it carries the details of cash, it carries the details of check and the person's account number, person's account name, and etc. things. And after depositing this slip, your amount will be credited in your account. Now the third thing a bank gives to its customer is checkbook. I guess you all are aware of checkbooks. A checkbook contains a number of leaves. A checkbook contains a number of leaves, which is 10 to 20 or 50 leaves called checks. Here the leaves is resembled with the checks. One check is equal to one leaf. Okay, one check is equal to one leaf. A check is an instrument used for withdrawing money from the bank. It is an unconditional order on the bank made by its customer, instructing the bank to pay the amount specified therein to the person named in the check or to his order or to his order. Here is the example of a check. It is the example of a check. It's a check picture. Here it is shown that we have to pay to the P Ramdev, and the amount is 1000, which is 1000 rupees. The date column is mentioned here. Okay, and there is shown the sign of the account holder. Please turn off your mic. Abdul Ibrahim, please turn off your mic. Thank you. Now, moving forward, crossing of checks. Crossing of checks. If two parallel lines are drawn on the left hand top corner of the check, it is called. Sorry for the inconvenience, guys. I have lost my connection. Now
No problem.
I've rebuilt it. Okay, just wait a minute. Just block second. Is book visible to you guys? Is it visible?
It's
Yes,
blurry.
yes, it's visible.
Okay. Now let's continue. So when we create a check, we just cross it by drawing two parallel lines. By drawing two parallel lines on the side of the check. So if we cross the check by just two parallel lines, and here between these two lines nothing has written, then it means it's a general crossing, and the check can be used in any kind of bank, in any kind of bank. And here it is written and company. It is a not negotiable check. Okay, it's like a choir holding a deposit. The check is concerned on the mentioned bank. The check is concerned on the mentioned bank. Whichever bank's name is mentioned on check, then you have to present that check on that bank only, in that bank only. That's what a crossing of check means it. Now coming to the endorsement and dishonor of checks. Endorsement and dishonor of check. If I say in simple language, suppose someone have given you a check, okay, and you have to pay to someone else. A have given you a check, A owes you and have gave you a check, and you owe from someone, and you need to pay that check to the C. When you just transfer the check by receiving the check from A and then giving it to the person C, then that's mean endorsement of check. That means the endorsement of check. If the check is endorsement, it means basically the check is transferable. The check is transferable. So a check is a negotiable instrument. A check is a negotiable instrument. It can be transferred to the another person by endorsement. The endorsement is done by the signing at the back of the check and writing the name of the party to whom it is to be transferred. For example, if a check payable to Mr. P. Ramdev is to be endorsed in favor of Mr. Kishan Lal, Mr. P. Ramdev will write at the back of the check as follows. So Mr. P. Ramdev will write this to this. Pay to Krishna Lal or order P. Ramdev, and he here will sign this check. That's how endorsement is done. Basically, we are transferring the check to someone else. Someone gave a check to us, and we are transferring the check to someone else to pay our debts. So that's what our endorsement is. Now coming to the dishonor of check. When the payment of a check is refused, it is said to be dishonored. Sometimes we say it like a check bounces. So when a check bounces, then it means it is a dishonor of check. When the payment of the check is refused, it is said to be dishonored. And the reason for dishonor of a check is when no date is written on the check, or a future date is written, or it is more than 3 months old. If a check is more than 3 months old, then it will be dishonor if you present it to the bank. If the amount written in the words differs from the amount written in figures. If the amount written in the words differs from the amount written in the figures. And the example of this is here. You can see it is a check. The amount is written in letters here. Okay. And the same amount is written in figures. So it should be same. Here it is written 1000, and here also it is written in figures 1000. So it should be same. Otherwise the check will be dishonored. When the drawer doesn't have sufficient balance in his account. If if you draw a check to someone, if you draw a check of 10,000 rupees to someone, and your bank balance is of only 5,000, then in that case that check will bounce in bank. So this was dishonor of check. Three column cash book, it is similar. Three column cash book is similar to the cash book or two column cash book. It is just this column discount allowed column adds here. Discount allowed column or discount received in credit side is added in the three column cash book. Otherwise it is same as the cash book. You can see it. In cash book we have just particulars and cash. Okay, and in two column cash book we have particulars, cash and bank, and in three columns cash book we have particulars, discount allowed, cash and bank, particulars, discount received in credit side, cash and bank. So that's the difference, and everything will be treated as same as the cash book. I hope you guys have revised the cash book and journal entries. And if you haven't done yet, then I insist please do revise the journal entries and cash book because it is the base of any financial account. Now we will see some example. Three column cash book. Now coming to the purchase journal. As it is a subsidiary book, purchase journal is also a subsidiary book. Purchase account we need to make through purchase journal. So purchase journal is used for recording the credit purchases for goods and raw material. Purchase journal is used for recording the credit purchase of goods and raw material. So as the sales journal. Sales journal is used for recording the credit sales of goods and raw material. Because as I mentioned earlier that if you are doing cash purchases, if you are purchasing goods and raw material in cash, then it will go in cash account, it will transfer in cash account, not in purchase account or sales account. In purchase and sales account only the credit purchase or credit sales will be transferred. You need to focus on this point. Okay, coming to the invoice. When you purchase something from a shop, you receive a bill. Such bill is called invoice. The receipt you receive while doing a purchase, that receipt is known as invoice. And that's how a invoice looks like. That's how a invoice looks like. I guess everyone here is aware of invoice. Here is the quantity, the particulars, rate per unit, total. We have the name of the company from which we have purchased, and here is the name if we are purchaser. The date. Now the particulars, it is mentioned we have purchased 10 copies, and principles and practice of accountancy. Principles and practice of accountancy by R. Shrirani. It is the book. We have purchased 10 copy of this book, and the rate per unit is rate of one book is 25. Now the total amount would be 250, and here they have provided us 10% discount, and 10% of 250 will be 25. Now we deduct the discount, and the total amount to be paid is 225. That's a invoice. Now it is a purchase journal. Don't think it is a purchase account. It is a purchase journal only. It's not a purchase account. Purchase account looks like purchase account looks like this. Looks like this. Every subsidiary account or subsidiary book, it will be look account. It will be look out like ledgers. This is the debit side of the purchase account, and this is the credit side of purchase account, the debit side and credit side. Date, this column is of date, this is of particulars, this is of the amount. Again, date, particulars and amount. Coming to the purchase journal. In purchase journal, we just record the transaction. We just record the transaction. If we are doing credit purchase, then we record the transaction. As we can see here, it in illustration number 6. Record of the following transaction in purchase journal of MS Dharamchand and Company and shows the ledger posting. Now, on July 1st, we have bought goods from Sridhar. We have bought goods from Sridhar. Amount 5,000. The entry would be like Sridhar, and this is the amount 5,000. Here is the invoice number, so we can refer in future if we have a doubt of amount, then we can refer to the invoice number. We always keep a record of invoices. We always keep a record of invoices and receipts. Now, the second entry, purchase goods from Shrikant worth 4,000. Shrikant 4,000. On July 3rd, we have purchased from Srinivas goods worth 2,500. Srinivas 2,500. Sridhar sold us goods. You see how it is return of purchasing. Here it is written purchased good from Shrikant. Here it is written Sridhar sold goods to us, or Sridhar sold us goods, means we have purchased goods worth 1,500. So we have mentioned it, Sridhar 1,500. Purchase goods from Srinivas subject to trade discount of 10%, 3,000. Here it is written we have purchased goods from Srinivas, and he have provided us a trade discount of 10%. The worth of goods is 3,000. But when we put a 10% discount on 3,000, the amount will come 300. The amount of discount will come 300. Now the 3,000, from 3,000, when we deduct 300, the amount will come 2,700. 2,700. In July 6th, bought from Shrikant goods worth discount 20%. Same again, the process we have followed here. The goods worth 3,500 and the discount they have provided us of 20%. Discount is 20%, and 20% of 3,500 is 700. 20% of 3,500 is 700. I hope you all know how to calculate a discount or percentage. So when we deduct 700 out of 3,500, the amount came 2,800. And when we do a total, it is written as 18,500 is the figure of total credit purchase our firm have made in July. Now we will transfer it in the ledger. So here the ledger accounts of Sridhar account. This entry belongs to Sridhar, 5,000. So when we purchase goods, what general entry we would have done? Like purchases account debit to Sridhar account, purchases account debit to Sridhar account. So here the Sridhar account is being credited by 5,000, and on July 4th as well, July 3rd. Here, the 1,500 amount is also considered under the name of Sridhar. So, the purchase account debited to Sridhar account worth rupees 500, 1,500. So, it is written here by purchases account, 1,500. I hope you remember this thing. We have done this ledger in last class. Now coming directly to the purchase account. Here we have seen the total of purchase journal is 18,500. 18,500. So the entry would be like purchases account debit 18,500 to Sridhar, Shrikant, Sridhar, Shrikant. It's like that. So purchase account will be debited. So here the purchase account is being debited and it is mentioned under the name to sundries as per journals. That means everyone's account. It includes Shrikant or Sridhar account. And the worth is 18,500. That's it. And in the same way we create sales journal. We create sales journal. In sales journal we record all the credit sales. We record all the credit sales. Here this is the sales journal. It's not sales account, it's sales journal. It is where we record the transaction when it happens, and accounts are the ledger when we transfer the amount of journal to the ledgers account. Okay. Here, the first column is of date, the second is of name of supplier to whom we have supplied our goods, and debit note number, because in case of purchases we receive a invoice number, but in case of sales we receive a debit note. We have a debit note number, and the ledger folio and the amount. August 1st. August 1st. So here in this illustration we can see sold to Dolat Furniture House, Delhi. First read the transaction. Read the illustration. Prepare the sales journal for MS Bharat Furniture Works. Bharat Furniture Works, Delhi, from the following transaction. As the name mentioned here, it is Bharat Furniture Works. Then it means that this firm deals in furniture. This firm deals in furniture. The sale and purchase of furniture here is being considered as asset sales, and not considered as asset sales or purchase. It will be considered as goods for this transaction, for this particular firm. The furniture here will be considered as goods only because it is a furniture firm, as it is mentioned here, Bharat Furniture Works. Now coming to the first transaction, in on August 1st, 2018, sold to Dolat Furniture House, Delhi, 50 chairs, rupees 150 each, and 10 tables, rupees 500 each, at a trade discount 10%. At a trade discount 10%. On sales, we provide the discount. We are the provider of discount. So basically, we are here allowing the discount to the supplier. So when we calculate the amount of chairs is 50 chairs and the amount of one chair is 150, then you can calculate it by multiplying 50 into 150, by multiplying 10 into 500, 10 into 500, and after adding this we can provide straight 10% discount in this, straight 10% discount in this. So when we multiply 50 and 150, the amount comes 7,500. 7,500. Here the amount will come 5,000. Here the amount will come 5,000. So in total it would be like 12,500. The amount will come 12,500, but we have provided 10% discount. We have provided 10% discount. So 10% of 12,500 would be 1,250. 1,250. And when we deduct 1,250 from 12,500, we get 11,250. 11,250. And we have mentioned this transaction like that: Dolat Furniture House, Delhi, debit note this, and the amount is 11,250. Amount is 11,250. And same goes with the remaining transactions. So that's how a sales journal looks like. Now when we post after doing all the transaction, it is the subtotal of sales. It is the sales 66,250 subtotal of sales amount. Now we will post it into the ledgers. Let's see. First, we have created Dolat Furniture House account, Keshav Memorial School, Maroli. We directly come to the sales account because we have discussed others ledger account previous as well. Sales account, because the entry of sales is like cash account debit to sales account if we are doing sales in cash, okay, but here we are doing it on credit basis. So the entry would be like the debtor account debit to sales, debtor account debit to sales. Keshav is our debtor here, Dolat Furniture is our debtor here. So the entry is debtor account debit to sales account. Now we have created the sales account. This is the debit side and this is the credit side of sales account. It is similar to the purchases account or any other ledger account, just like date. This one is for particulars, this column belongs to the amount, and again date of credit side, particulars of credit side, and the amount of credit side. Because the debtors account debit to sales account, we know the sales have a credit balance, we need to credit the sales account. So we are crediting the sales account here, we are crediting the sales account here by our debtors. By our debtors, we can just use by sundries debtors as per the sales journal, and it includes all Pyare Lal, Keshav Memorial, Daulat Furniture, all. And the amount is mentioned here is 66,250, which is a total amount. So that's how we create a account. Now coming to the sales return journal, we have created sales of rupees 66,250, but some of our goods have damaged, okay. Now the customers wants to return our goods. So the returning inward of the goods is known as sale returns. Return inwards of the goods is known as sales returns, or we can just say return inwards, because the goods are coming to in our firm only, the goods are coming into our factory only, so returns inward. This is the credit note, because when we sold the goods, we have provided a debit note to them. Now they are returning this thing to us. Now they have provided a credit note. They have provided a credit note. So that's how a sales return journal looks like. Sales returns have a different journal, and similarly, purchase return journal is also a journal. It also have a different journal. Purchase return also have a different journal, just like the sales return have. Here the name of supplies, credit note number, amount. Dolat Furniture House have returned goods worth 585. Keshav Memorial School, Mehrauli have returned goods worth 1,170 here. Pyarelal Furniture Palace have returned the goods worth 200 here, and the total amount of goods which are returned to our factory or to our firm is 1,955. Now, in the ledger, we will post it as a sales. We have shown in their ledger like we have did a sale of 11,250 to the Dolat Furniture House, but now they are returning our They are returning our goods. Now they are returning our goods. So the entry of sales return is sales return account debit, sales return account debit to Dolat Furniture House account, sales return account debit to Dolat Furniture House account. Or in general, if I say, then the entry would be sales return account debit to debtor account, sales return account debit to debtor account. So here it is the sales return account. As we have debited the sales returns account, so we are showing it in sales return. And here the name of debtor is mentioned, but we have more than one debtor here. So by combining all these things, we are just writing to sundries as per the sales return general and putting the amount of sales return 1955. So that's it. So the unit is completed. Moving further, you need to practice this thing again and again. Then only you will be able to hold on financial accountancy. Practice is must in financial accountancy. Now, after creating journal or creating journals, transferring the journals into ledger accounts, or creating subsidiary books in case of big firms, now we create a trial balance. Now we will create a trial balance. So, what is a trial balance? This is the first question comes to our mind. So trial balance is a statement that shows the debit and credit balances of the ledger account to test the arithmetical accuracy of the book. To test the arithmetical accuracy of the book. So it is necessary to ascertain the accuracy of these entries before we proceed with the preparation of final accounts. For this purpose, we prepare a statement called trial balance. We have created ledgers, we have created journals. Now we have to just go to the final accounts. But to check the accuracy, of accounts, that we did the transaction, or we transferred the transaction in a right portion, in right amount, or in right form, like we have followed the rule, we have debited the thing we need to debit, we have credited the thing we need to credit. Because preparing accounts is done by humans, okay, and human can do mistakes while preparing those accounts. To check those things, we create a trial balance, because it is a mediator between final accounts and the journal accounts. After creating journals and posting them into the ledgers, we create trial balance so that we can check that we have passed every journal entry in a right form. We have passed journal entry in right form. So to check this, we create trial balance. Now, if the account shows a debit balance, its amount is entered in debit balance column, and if it shows a credit balance, the amount is entered in the credit balance column. So we have 2 points, or we have two methods to create a trial balance. Either we can transfer the ledger amount, the ledger remainings, directly to the trial balance, or if the question asks us to just transfer the journal and to just transfer the transaction as they have asked in the trial balance. Here, a definition is also written of trial balance. Trial balance can thus be defined as a statement listing in separate columns the debit and credit balance of the ledger account on a particular date. Preparation of a trial balance. It is a full-fledged question. We will do this later. First, we need to see trial balance. Preparation of trial balance from the given list of balances. For doing this, let me show you the format of trial balance. Here is the format of trial balance. This is trial balance. Here, the name of account is mentioned. Here, the ledger folio is mentioned. Okay. Here, the debit balance is mentioned, and here it is the column for credit balances. The name of account is capital. We create a capital account in ledgers. We create sales account as well. We create assets account, which is land and buildings, machinery. We create a separate debtor account. So these are all the ledger accounts. These are all the ledger accounts. And the remains, the balance shows whatever balance a ledger account shows, we transfer it here in the form of debit balance or credit balance. In the form of debit balance or credit balance. Before doing this, we need to know some things about trial balance. The first thing first, all account of expenses and losses will be debit balance, including purchase. Because in these things we loses cash while doing expenses, while purchasing raw material we lose cash. Okay, so they have a debit balance, all accounts of income including sales and gains will have a credit balance. In these case we gain amount if we are selling something, if we are selling an asset, then we are getting the cash or bank amount in the form of receiving. If we are doing sales, then in return we get cash or bank. So we just credit the balance of these things, like sales account have a credit balance, or selling of an asset have a credit balance. If you are purchasing an asset, then it will show a debit balance. If you practice this thing, you will become a pro in this, but you just need to practice it. I keep repeating of practice here because it is actually required in this subject. Practice is actually required in this subject. All accounts of assets will be debit balance. All account of assets will be debit balance. All account of liabilities will have a credit balance. As you know, capital is also the liability of the firm. Capital of the owner is also the liability of the firm. So capital also have a credit balance. Capital also have a credit balance. Now, drawings have a debit balance. Drawings have a debit balance. If you want, you can take a screenshot of this thing. These are some rules. So before moving directly to this question, let's go back to that question. I just needed to show you the trial balance first. This is the illustration number first. The following is the balance sheet of Kapil Dev as on March 31st, 2018. And it is a horizontal balance sheet which have liabilities and assets like this. This portion is of liabilities and this right side is of assets. Capital worth 50,000, loan from bank 8,000, due to Saluja Bros 15,000. Coming to the assets, cash in hands is our asset, so they are under the asset form, which is 15,000. Stocks are also our assets. It is of 50,000. Due from Khanna 1,500. These are our debtors. Okay. Due from Mittal and Furniture. These are our debtors. Debtors are our assets because they need to pay to us 2500, and the furniture is also our asset, and the amount of furniture is 4000. Now, these are the transaction took place during the April 2018. The balance sheet is of 31st March 2018 because every accounting year starts from 1st April and ends at 31st March. Every organization, uh, every organization close their accounts on 31st March of every year. Okay, they create a liability and assets by closing their. Now, you can just read these things: paid wages and salaries, cash sales of bicycles, purchased 20 bicycle on credit from Mehra Cycle and Company, rupees 600 per bicycle, sold 30 bicycles to Mittal, paid to Saluja brothers in full settlement of their account 14,600, received from Mittal two bicycles as defective and sent him a credit note, and so on and so on. We're not going one by one to each transaction. We know how to create a cash book because we discussed it in earlier class. And these are the journals or subsidiary books. We just go directly to the ledgers. I just wanted to show you the balance. Ledgers. So the capital account. The capital account. The balance of capital account showed in balance sheet is 50,000. Showed in the balance sheet is 50,000. So here the capital account is 50,000. Now on 1st April the capital balance will be 50,000 when we calculate it. When we calculate it, the balance brought down here is 50,000. So the balance will be on credit side. As I said, capital is also the liability. It will be shown in credit side. Here is the example. You can see. Now, Saluja Brothers and account. Cash account debit to Saluja's. We have done sales to this person, Saluja's Brothers and account. And when we created this, we have a balance. When we calculated this, don't include this 2200. Don't include this in the account first. Just calculate it. So our credit side is greater than our debit side. Credit side is greater than the debit side. So to maintain the balance, to maintain a balance, we have to carry this 2200 rupees amount under the name of buy balance carry down. It is the balance, buy balance carry down, and again it will be forwarded. Again it will be forwarded on the first date of any month, which is by balance brought down. By balance brought down. So it shows a credit balance as well. It shows a credit balance as well. And if we check our trial balance, then we can check this amount in the credit side. Here it is. Capital. Capital we just read have a credit balance. Here it is mentioned in the credit balances. Saluja Brothers, we just read this account. Here the amount is shown in credit balances only. Kutub Typewriter Company. Kutub Typewriter Company. Buy typewriters. 6,500. 6,500. And the amount is to balance carried down 6,500. Now the balance brought down is 6,500 only. The balance brought down is 6,500 only. So where is Kutub typewriter? It will be mentioned in credit side only. Kutub typewriter 6,500 as it is shown here. Here the amount is not shown, it's a misprint, but by balance BD it will show 6,500. Okay. Wages and salaries account. Wages and salaries account. All expenses need to show a debit balance. Wages and salaries is also our expense. We have paid wages and salaries to the employees and laborers. So the entry would have been like wages and salaries account debit to cash. Wages and salaries account debit to cash. So here it is, wages and salaries account is debited. Wages and salary account is debited and mentioned here to cash worth rupees 6,000. In trial balance, it will show a debit balance. Wages and salaries account. Here it is mentioned. Wages and salaries under the amount 6,000 in debit balance. You can see it is debit balance. So that's how a trial balance work. That's how a trial balance work. And when we complete all the transaction, when we put all the ledgers in trial balance and calculate both the side, then it is must they tally. It is must that the debit and the credit side tally. The debit side comes equal to the credit side, and if it is not happening, then it shows that we have made a mistake in journals or in ledgers. We have made a mistake in journals or in ledgers. Is it clear? Trial balance. It needed to uh, show a equal figure, and if it is not, then we have to check our ledgers and journals again. It is just like the balance sheet. The debit and credit balances must be equal. As here you can see, it is equal. Moving to next point, if you want to screenshot some illustration, then you can start from here, screenshot it, and try to create it on a pen and paper, using a pen and paper, and to tally your trial balance. To tally your trial balance, you can take a screenshot of this as well. Have you guys taken the screenshot? It's the homework. It's your homework. You need to do it. Are you guys even listening?
Yes, we are.
Take screenshot of it. I'm showing one
Yes, we.
another illustration.
Okay.
Take screenshot of that too. Okay. Wait.
Okay.
It's not that. Wait. The first illustration. These are the rules to create a to create a trial balance. Take a screenshot of this too.
Okay. Done.
Illustration number. Take a screenshot of this illustration too, as it shows different balance in debit side or in credit side on credit side. So you need to create a balance between debit and credit balance. Take a screenshot of this and I will show you the answer as well.
Done.
And its answer is this. It will help you to understand trial balance in deep. So try doing these questions of trial balance, these two questions of trial balance, and along with that, do practice of journal entries and ledgers.
Okay.
Now moving further. Causes for the disagreement of trial balance. As you have seen in the last illustration, they were showing a different balance. They were showing a different balance. As you can see here. Here the debit balance shows an amount of 10 lakh 83,600 and the credit balance shows the amount of 7 lakh 16,400. So why this difference is here? Why it is showing a difference? What are the causes of the disagreement of a trial balance? The first cause is omission of posting in one account. So it is possible that we omit to post entry of one account. For example, an amount of rupees 200 received from Ali correctly entered on the debit side of cash book. Correctly entered to the debit side of cash book but is not posted on the credit side of Ali account, because when we have received amount from Ali, then the journal entry would be like cash account debit to Ali account. Now we have shown it to the cash account. We have posted it to the cash account with the amount of 200. But we have not posted, we have omitted to post it on the credit side of Ali's account. So it can create a disagreement in trial balance. Omission of posting in one account can create disagreement of trial balance. Suppose if we omit a entry only, okay, we omit a transaction, we omit a full transaction, then in that case it won't affect our trial balance, because we just removed that transaction. Our trial balance will show a balance. Okay, our trial balance will show a equal debit or credit balance in that case if we just omit an entry. But here we have omitted only one part of the entry. We have omitted only one part of the entry. Now, double posting in one account. Double posting in one account. Taking this example again, suppose you have debited the cash account two times. You have debited the cash account two times. So it will shows a double posting in one account, and it will create a disagreement of trial balance. Posting on the wrong side of an account. Taking that example again, the entry would have been like cash account debit to Ali account, cash account debit to Ali account. But suppose you posted it credit side of the cash account. You needed to post it on the debit side of the cash account. You needed to post it to the debit side of cash account, but mistakenly you have posted it on the credit side of the cash account. So posting on the wrong side of an account also can create hindrance in the balance of trial balance. Posting wrong amount in the account, posting wrong account in the amount, like posting amount of rupees 1000 instead of 100. Okay, or vice versa, posting the amount 100 instead of 1000, because these are human mistakes. Humans are creating accounts, and we can do mistakes as well. Wrong totaling of the subsidiary books. Wrong totaling of the subsidiary books. We can calculate wrong as well, so it will create a hindrance here. Omitting to post the total of subsidiary book. Omitting to post the total of a subsidiary book. Suppose we omit to post capital account in trial balance. Suppose we omit to post the ledger of sales account in trial balance, then it will show a misbalance in debit or credit side. So these are the reasons. These are some reasons which create a disagreement in trial balance. Now moving further, locating errors when the trial balance disagree. How to locate the errors when the trial balance disagree? So at first we check the total of debit and credit side column again. Okay, we check the totals. It could be like that we have done a wrong calculation. We could have done the wrong calculation of debit or credit side. So just double check your calculation of trial balance. Again, if your calculation is strong, if it is right, then move further. You need to check the journal entries or ledgers account. If the difference still persists, ascertain the exact amount of the difference. Then, at first, see whether an account having the balance has been omitted from the trial balance. Just check. Just tally that you have not omitted any account. Just tally that you have submitted or you have transferred the actual amount which is shown in a ledger account. You have posted the actual account or the correct account amount. Check whether an account with a balance equal to the difference has been entered twice in the trial balance. Take the half amount of difference. See whether there is any account with such balance in it, trial balance, and if so, check whether it is entered in the correct column or not. You need to check the column too. Sometimes you can put the capital account on the debit side of trial balance, then it will show a misbalance while totaling the trial balance, because the capital account needed to go on credit side only. You need to check if you have posted it in the right column. So these are the things you can do if you found disagreement of trial balance. Errors not disclosed by trial balance. Errors not disclosed by trial balance. Error of principle. Error of principle. When transaction has not been recorded as per the rules of debit or credit, or some other accounting principle has been ignored, the errors so arising called errors of principles. One example of this error is like salary paid to Sham, recorded in cash book. Salary paid to Sham. The entry could have been like salaries account debit, salaries account debit to cash, recorded in the cash book as a payment to the Sham. This result in debiting Sham's personal account instead of salaries account. This result in debiting Sham's personal account instead of salaries account. You could have done that Sham account debit to cash account, but you have paid salary here. It is shown in salaries account. The entry should have been like salaries account debit to cash account. So in this case you can see this is the error of principle. Now, error of omission, when we forget to record a transaction or when we forget to transfer a transaction. When a transaction is completely or partially omitted to record it in the books of account, it is called error of omission. It is called error of omission. If the transaction is omitted to be recorded in the subsidiary books or its posting is completely omitted, it is called an error of complete omission. Or if it is omitted partially, then it will be known as error of partial omission. Here it is also mentioned the error of complete omission do not affect the trial balance, as I explained earlier, because when we forget the transaction completely, then it will not affect our trial balance because we have not recorded that transaction anywhere, not in journal, not in ledger. Then how will it affect our trial balance? But the error of partial omission would certainly cause the disagreement of the trial balance because they would lead to either short debit or short credit. Some error of commissions. When an error is committed in recording the transaction in subsidiary book with the wrong amount, suppose we have recorded a transaction or account with a wrong amount. We have recorded 1000 instead of 100. So it is an error of commission, or is committed in posting into wrong account. We have posted the transaction into wrong account, to the wrong side of the account. We needed to debit one account, but instead debiting, we have credit that account. So in these cases, all these cases, it is known as error of commission. And so on. So these are some there are some advantages and limitations of the trial balance. The first advantages of the trial balance is it tells us about the arithmetical accuracy of our accounting entries. Suppose we do not have a trial balance. We just created journal, then posted it into the ledger, then creating final accounts out of it, trading account, profit and loss account, and balance sheet. And then we will know that we have created a mistake in journal. So, reducing this or removing this inaccuracy, we create trial balance because it tells us in between that our account or our arithmetical accuracy is here in the accounting entries. We haven't forget any entry. It tells us about this. It contains the balance of all ledgers account on particular date. It contains the balance of all ledger accounts on particular date. So when we want to go through the ledgers, we just know that this page belongs to, or this date belongs to this ledger account. Okay, and this amount belongs to this much sales we have done, this much purchases we have created, that much cash we have used. So it shows these things. It acts as a basis of preparing the final accounts. We create final accounts on the basis of trial balance now. Okay, we create final accounts on the basis of trial balance because it have information of the all the ledgers. It have information of all the ledgers. So it makes easy to create final accounts. Regular preparation of trial balance ensures that the accounting staff will work carefully. The accounting staff work with carefulness. Limitation of a trial balance. Trial balance doesn't disclose all types of errors. Now, again, I'm saying, suppose we have omitted a transaction fully. Okay, we haven't recorded that transaction in journal and didn't post it in ledger, then it will not. The trial balance will not tell us about those omissions because it will not show any kind of effect in trial balance. A trial balance doesn't provide any additional information. You cannot have any idea about the net result of trading activity or about financial position directly from the trial balance. For knowing the financial position, we need to go through the final accounts, which is profit and loss and balance sheet. Now we know we have created errors while creating the trial balance. How can we rectify those errors? How can we rectify those errors? So errors can be of two side. Okay, one-sided error or two-sided error. One-sided error or two-sided error. Certain errors affects only one side. One-sided errors affects only one side of the account, either debit or the credit side. Such errors are called one-sided errors. Now, example: we received 100 rupees from Deshmukh, was posted to his account as rupees 10. It means Deshmukh account has been credited with 10 instead of 100. There is no mistake in cash book. There is no mistake in cash book. So such type of error will affect only one side. Will affect only one side of trial balance. The second example is the purchase book is overcast by rupees 1000. This will affect the debit side of purchase account where the total of purchase book is posted and no other account is affected here. Coming to the two side error, these error affects more than two accounts, either two or more than two accounts. Such error are called two-sided error. Now the example of this is a credit sale of 1080 rupees to Anand was wrongly recorded in the sales book for rupees 1800. For rupees 1800. So we have created the journal entry like say Anand account debit to sales account. Anand account debit to sales account worth rupees 1800 rupees worth 1800 instead of 1080 instead of 1080. So these kind of errors we do on both side of the accounts, it will affect Anand's account as well as the sales account. It will affect both Anand and sales account. So in that case, it will be considered as two sides error. Now, how can we rectify one-sided errors? How can we rectify one-sided errors? As we discussed one problem in the one-sided error, Deshmukh account, we have wrongly debited, we have wrongly credited 10 rupees instead of 100 in Deshmukh account. We have wrongly credited 10 rupees instead of 100. So the Deshmukh account is short of 90 rupees. But now we can rectify it by passing this entry by the difference in amount received from him posted on rupees 90. We can now credit the Deshmukh account for worth 90 rupees. For worth 90 rupees. Why 90? Because we already have credited the Deshmukh account with 10 rupees when we needed to credited it with 100 rupees. Now the balance remains 90 rupees. So now we will credit the Deshmukh account with 90 rupees. That's how we rectify one-sided entry. That's how we rectify one-sided entry. Coming to the next part, rectifying. Let's read this thing. A credit sale for rupees 1000 to Tiwari was posted to the credit side of his account. A credit sale for rupees 1000 to Tiwari posted to the credit side of the account. Before reading the wrong part, you need to create a journal entry for the right part. Okay, a credit sale for rupees 1000 to Tiwari. So the entry would have been like Tiwari account debit to sales account. Tiwari account debit to sales account. But Tiwari was posted to the credit side of his account. Tiwari was posted to the credit side of his account, and the amount of debiting was 1000, and we have credited the Tiwari account with 1000. Now, how we will rectify this entry? This is the Tiwari account, this is the debit side, this is the credit side. We have mistakenly credited Tiwari with 1000 rupees. We have mistakenly credited Tiwari with 1000 rupees. Now to nullifying this effect, we need to debit the Tiwari account with 2000 rupees. We need to debit the Tiwari account with 2000 rupees. Why 2000? First one is because we have credited, first 1000 is because we have credited the Tiwari account with 1000 rupees. First 1000 rupees is to nullify the Tiwari account. And the second one is because we have purchased, or we have did a sale to Tiwari, we have did a sale to Tiwari worth rupees 1000. So it is for the sales. So 1000 and 1000, it will create 2000. The posting of sales made to him on credit side now rectified, and the worth is 2000. In out of these 2000, 1000 rupees is to nullifying that credit effect, and the 1000 rupees is to debiting the Tiwari account. To debiting the Tiwari account. So that's how we do rectification of errors. Now doing rectification of two-sided errors. Rectification of two-sided errors. This is the first case we have read. The case of first example of two-sided errors given in earlier. A credit sale of rupees 1080 to Anand. The entry would have been like Anand account debit to Anand account debit to sales account. Account debit to sales account was wrongly recorded in the sales book. Was wrongly recorded in the sales book at rupees 1800. 1800. Okay. Now rectify this entry. The two account affected here is Anand account, which shows an excess of 720, and the sales account, which stands credited in excess by 720. From where this 720 amount comes from? Because we needed to pass the entry with 1080 rupees, but instead we passed the entry with 1800. So the amount or the balance of 1800 and 1080 is 720. The difference between 1800 and 1080 is 720. So we need to create a rectifying entry. To rectify this error, we must credit Anand's account with 720 rupees and debit the sales account with rupees 70 with rupees 720. Anand's account debit to sales account. We would have passed this entry Anand account debit to sales account 1800 and 1800. The amount here goes wrong by 720. To correct this, we need to credit the Anand and debit the sales account to nullify the effect, because in the real entry we have done Anand to sales, we have done Anand to sales, but to nullify the effect of 720 we need to reciprocal this entry. We have created sales account debit to Anand, sales account debit to Anand. The amount of nullifying is 720 and 720. This is how we rectify two side errors. Now read this. Not only sales, let's take some other example. Let's take some other examples. Every illustration is about sale. Let's just move. So this is how we do rectification of two-sided error. Now we will see the suspense account and rectification. The rectification we have learned before this. These are the rectification we do while preparing or before preparing the trial balance. Now suppose you have prepared the trial balance, you have created the trial balance, and now it shows a misbalance between debit and credit side. Then what will you do? You cannot just go to the accounts and cutting the books or ledgers and adding some amount there. No, it don't we don't do these things. Instead we create a suspense account. Instead, to create or nullify the effect, we create a suspense account in that case. So for example, rupees 580 received from Sham were posted to his account as 850. Rupees 580 received from Sham means cash account debit to Sham 580 rupees were posted to his account at rupees 850. It means Sham's account is to be debited with 270. we have posted it with 850. So the difference between 850 and 580 is 270. We have credited we have credited the Sham's account with 270 rupees more. So to nullify this effect, now we have to debit the Sham account debit 270, and we haven't passed any wrong entry in any of the account. So in that case, we just open a account which is suspense account. Sham account debit 270 to suspense account 270. Sham account debit to suspense account 270 and 270. In these cases, we open a suspense account when we do not have any another account, so we can nullify the effect. In those cases, we open a suspense account. So that's it. That is what a rectification is. Now, this unit or block is completed. Rectification was the last part of this unit. Now we will move to the next block. Please do practice of journal, ledgers, and trial balance. You need to work a little hard for this subject. You have to put efforts in this subject. So now I am presenting you the new block, which is block number third. So this is block number third. In this, we will learn about depreciation, final accounts first, and final accounts second. Moving directly towards the depreciation. So what is the depreciation? What do you know? What do you mean by depreciation? Anyone want to answer?
Now it does like you use something.
Depreciation is when something value
Your voice
reduces.
is breaking.
The reduction of something
Okay, your voice
value.
was not clear, so let me
Because
explain. Let me explain. Depreciation. Basically, in simple language, we say it is a fall in the value of asset. It is a fall in the value of asset. Take it like this: we have purchased a machinery for rupees 50,000. Not a machinery. We have purchased a computer or a laptop worth 60,000. Okay, after 2 years, when you go in the market to sell the same laptop, you will get rupees 25 or 30,000 for it, because they will say that its value only this amount, this much of amount. So the difference from 60,000, the value becoming 30,000. What is this? This is the depreciation, because you have used that laptop. Okay, you have overused it. It have become obscene. It have become obscene. Depreciate is the reduction in value of something. Example, product or asset. Yes, you are pretty much right. Your answer is correct. Depreciation is the fall in the value of an asset. So when you go in market and sell your try to sell your laptop and you get only 35,000 for the same asset, for the same laptop you have purchased of worth 60,000, then the value, the reduction in the value of an asset is known as a depreciation, is known as depreciation. Now read this. Allocation of the appropriate amount of each period is called depreciation, which represent the expired portion of the cost of an asset, which represents the expired portion of the cost of an asset. Now you have purchased a machinery. You have purchased a machinery of 1 lakh rupees for 1 lakh rupees, and you have estimated its time, or you have estimated the age of that machinery is 10 years. 10 years. So each year the value of machinery will go down. The value of machinery will go down, and that fall in the value of depreciation in the machinery is known as depreciation. That fall in the value of that machinery is known as depreciation. Now moving further, I guess depreciation is clear. Moving further, depreciation and other related concepts. Depreciation and depletion. See, depreciation is the reduction in the value of all fixed assets. Okay, it is a fall in the value of all fixed assets. But depletion, it is the reduction in the availability of the quantity of natural resources. Of natural resources. When there is a reduction in the availability of quantity of natural resources, then that is known as depletion. It is a wasting asset. Okay, we have less water on this earth now, so it is a depreciation because water is a natural resource. Depreciation is applied for fixed asset. Depreciation, the word is used for fixed assets. Depreciation and amortization. Depreciation and amortization, they somehow are similar. Okay, they somehow are similar. They are used, they both are used on fixed assets, but depreciation is used on tangible assets, assets like furniture, computers, machineries, plant and machineries. Okay, and other stuff, land and building. Depreciation is used for tangible assets which you can use, see, and touch. But amortization is used for, now I know why people use this English when talking. Example, the price of the bag has depreciated. Okay. Amortization, I was on amortization. Amortization is used for the assets only, but these are used for intangible assets, assets like goodwill. When your goodwill reduce, then it will not be said that it got depreciated. It will be said that it is amortized. The value of your goodwill is amortized. Okay, goodwill, patents, so these are the things, these are the assets, copyrights, patents, goodwill. So in those things we have amortization, but in tangible assets like machinery, furniture, building, plant and machinery, plants, and other stuff, we have a depreciation on these tangible assets. Just remember, depreciation tangible assets, amortization intangible assets. Depreciation and obsolescence. Depreciation and obsolescence. See, depreciation is the fall in the value of an asset, but obsolescence is decrease in the usefulness of an asset due to new invention, change in technology, and etc. Because our environment is a changing, it is dynamic in nature. Our environment is dynamic in nature. Things keeps on changing. things keeps on changing. In earlier ages, if we talk about 20 years ago, then we didn't have smartphones in our hand at that age. But due to the time due to the time, now the keypad phones have become obsolete. Phones have become obsolete because everyone now have a smartphone in their hands. So obsolescence is key, the change in technology, the development in technology, new invention. If we talk about the textile industry, we talk about the clothes industry. Fashion keeps on changing. At earlier ages, the skinny jeans have topped the fashion of the cloth industry. But nowadays, the baggy clothes are at the top of the fashion industry. So we won't say that the skinny jeans have a depreciation. No, they got obsolete. They got obsolete. You understanding my point? I guess yes. Moving further, depreciation and fluctuation. Again, depreciation is a decrease in the books of asset, which shows depreciation in the books of asset as in the form of depreciation. But fluctuation is increase or decrease in the market value of asset. In the market value of the asset. Suppose you have purchased a land for your firm. You have purchased a land for your firm, and you have purchased the land for worth 10 lakh rupees, but now its value is 8 lakh. Its value is 8 lakh in the market.
Yes, ma'am.
You were saying something? You were saying something? Is my voice clear to you guys? Please write it down if my voice is breaking and am I not a bit audible.
You are clear, ma. You are clear.
Okay. And fluctuation is increase or decrease in the market value of an asset. Increase or decrease in the market value of the asset. In depreciation, there is only decrease in the value of asset, but in fluctuation it is an increase or decrease in the market value of an asset. Suppose, as a firm, you have shares of a company. So one day the value of the shares is going up, and the another day the value of the shares is going down. So it is fluctuating. The increase and decrease in the asset value is fluctuation. So these are the difference between these terms. Yes, causes of depreciation. What are the cause of depreciation? Wear and tear. When we use machinery, suppose we are in a business of transportation. Okay, we are in a business of transportation. The cars or the trucks are running on the roads. So using them, using them can create a depreciation in the value of that asset. Tires may get friction due to friction, and the engine can cause something, okay, depreciating. The truck could lead to an accident, and it will reduce the cost of that truck as well. So wear and tear, using a thing and reducing it, is the cause of depreciation. Lapse of time. Normally, the passage of time also causes some reduction in the value of fixed asset, because as they become old, their value stands reduced, because it's a changing market. It's a developing market. We are living in a developing market. Every day new products are coming of every product. Okay, a new version of every product is coming every day. So after a time, the value of a good, a particular asset become low. Okay, it will fall. Obsolescence, as I have cleared it, obsolescence, because it is a changing environment, fashion keeps on changing, so things go obsolete. Yes, since the fluctuation refers to either the increase or decrease. Is it the correct? See, if we are talking about the land, land is considered as the fixed asset of a firm. The value of land can be decreased. Okay, but sometimes due to some projects, the value of land go increase. So this is the fluctuation. This is the fluctuation in the fixed asset. It can be increased or decreased. If it is increasing or decreasing, then it will be known as fluctuation. Okay. Depreciation is going for a long time period. Depreciation is going for a long time period. Fluctuation is not going for a long time period. It goes in recent times. Today it is today the value of a product is increasing. The next day it is decreasing, and you can take it like this. You can take it like this. Fluctuation in corona time, the value of mask, the value of mask and sanitizer got increased, they got hiked. So it is a fluctuation. But after the corona, if you go uh, if you go in a chemist shop to purchase sanitizer or mask, if you compare it with the corona time, the product value, if you compare the value of that product from corona time to now, you will see the fluctuation increase or decrease. So that is what a fluctuation is, but depreciation remains for a longer period. Now moving to the next thing, objective of providing depreciation. Why we, okay, now we know our asset go depreciation, our assets go under depreciation, but why we need to consider it in our books of accounts, why to mention the less value of our books or less value of our accounts in our books of accounts. Now, first one is ascertaining the true profit. Ascertaining the true profit. Suppose your the value of your machinery is 50,000. The value of machinery at present time is 50,000, but you are still showing it, you are not adopting a depreciation, and you are still showing 70,000 value of your machinery, 70,000 value of your machinery in the books of accounts, then it will give a false, or it will give a false ascertaining or false position of your firm. So to reduce this or to avoid this thing, do we apply depreciation in our firm on the fixed assets. Ascertaining the true cost of production. Depreciation on machinery and other fixed assets in the factory is an important component of cost of production, especially when the units is not labor intensive. So, if no provision is made for depreciation, the cost calculation will be incorrect. The cost calculation will be incorrect. If we are using our machinery, if we are using our machinery to produce goods, then we add the cost, we add the value of machinery or the part of the value of machinery in the cost too. But if we are not depreciating our machinery, if we are not depreciating our machinery, then it will give us the incorrect digit, it will give us the incorrect cost. That's why it is needed to depreciate the machineries. Presentation of true financial position. Funds for replacement of assets. Charging the depreciation reduces the profit available for distribution. It enables the concern to retain the part of its profit and thus accumulate funds for the replacement of an asset. Suppose you are a company, okay, you have created a company. Now you are not putting depreciation, you are not applying depreciation any of your assets. So all the balance comes goes to your profit, all the balance goes to your profit. Now you have to share that profit with your shareholders. But but if you have provided depreciation, in that case the value of asset will be removed or reduced, so the amount of profit will also be reduced, the amount of profit will also be reduced. So that's why it is needed to do depreciation. Now we have at least 7 to 8 methods of calculating depreciation. We have 7 to 8 methods of calculating depreciation, but you need to know only two methods. You need to know only two methods. In your syllabus, there are only two methods. First one is SLM method, and the second one is written down method. Written down method. See, these are the methods. These are the 8 methods for providing depreciation. But you need to know only fixed installment method, which is also known as SLM method, straight line method. We say it straight line method, and the second one is diminishing balance method, or written down method. We say it written down method. Only two methods you need to know. So, what is the difference between? Let me explain the difference between fixed installment method and diminishing balance method. These these are the two types of method we calculate depreciation. Okay. Now coming to the fixed installment method, understand it with an example. Suppose you have purchased a machinery of rupees 1 lakh. You have purchased a machinery of rupees 1 lakh, and it is showed that you needed to apply you needed to apply depreciation of rupees 10,000 every year. You needed to apply depreciation of rupees 10,000 every year, or it will be said that apply 10% depreciation, apply 10% depreciation with SLM method or fixed installment method. In that case, every year you apply a depreciation of rupees 10,000. For first year, the value of machinery is 1 lakh. The next year, you will apply 10,000 depreciation, which will reduce the value of machinery to 90,000. And the next year again you will apply the depreciation of rupees 10,000, and the value will remain 80,000. And the next year again you will reduce the value of depreciation is 10,000, and after reducing you get the value 70,000, and it will work so on. So there is a fixed amount in fixed installment. There is a fixed amount of depreciation which you have to put every year, every year while calculating the asset account. Either it is machinery, or it is plant and machinery, land and building, furniture, or anything. Okay. In diminishing balance method, it says, the question says, you have purchased the machinery worth rupees 1 lakh. Now you have to put depreciation of 10% with return down method, or diminishing method. So in that case, it just says you need to put 10%. You need to calculate the 10% on the remaining value. Like, in first year the value of machinery is 1 lakh. Okay, you you apply 10% depreciation on 1 lakh, which will amount of rupees 10,000. And when you reduce 10,000 from 1 lakh, the amount becomes 90,000. The next year you do not reduce or apply the depreciation of 10,000. Now you do not do it here. You just apply 10% on 90,000. Now you just apply 10% on 90,000. and the value of depreciation will come as 9,000. After you do reducing 9,000 from 90,000, the value come 81,000. Now next year you will apply 10% discount on the remaining value, which is 81,000. The 10% of 81,000 is 8,100. Now you will reduce 8,100 out of 81,000, and it will go so on. Now we will see the examples and learn it in a better way. I have given a brief view about both the depreciation. uh, you can relate the diminishing balance method with compound interest. You know, the compound interest, the interest on interest, interest on interest, and the fixed is just like normal interest. So this is that. In interest we add the amount, but in depreciation we reduce the amount. That's the difference. Now let's see fixed installment method. This method is also called as equal installment method, or straight line method, which is SLM method. Under this method, a fixed and equal amount is charged as depreciation every year during the lifetime of an asset. When this amount of depreciation is presented on the graph paper, it would show a straight line parallel to the x-axis, hence the alternative name straight line method. So the annual amount of depreciation to be charged under this method can be calculated with the help of the following formula. We know we have to use a equal installment method here. The same amount we need to reduce every year in this method. So to calculate that amount, we have a formula. To calculate the amount of depreciation, we have a formula. Annual depreciation is equal to cost of the asset, original cost of the asset minus scrap value, minus scrap value, and divided by life of the asset in numbers of year. Life of an asset in numbers of year. Basically, cost. Here, the cost includes purchasing price, freights, and installation cost. You have purchased a machinery. You have purchased a machinery worth rupees 1 lakh. You have paid freights. You have paid freights worth rupees 10,000. Okay. Now the cost is 1 lakh 10,000. Now for the installation of the machinery, you have paid 40,000. Now the total cost of that machinery will be 1 lakh 50,000. When you add 1 lakh 10,000 plus 40,000, the value will come like 1 lakh 50,000. The cost will be like 1 lakh 50,000. So cost include purchase price, freights, and installation cost. Coming to the life of an asset in of years, it is a estimated working life of an asset. I have purchased a machinery, then I estimate it will work for 7 years for me, it will work for 8 years for me. So basically, it is an estimation. And the scrap value, estimated scrap value, it is an estimated scrap value. We estimate like when after the 8 years, this machine we can sell with 20,000. Okay, at least 20,000. The value of machine is 1 lakh 50,000 right now, but after using 8 years, we can sell it of 20,000. So that is a scrap value. These both things are estimated. These both things, scrap value and life of the asset, is both estimated. Okay, so that's how we calculate the annual depreciation. Just take an example. Take this example. Ravi Kiran and Sons purchased machinery on January 1st, 2015 for rupees 22,000 and spent 3,000 on its erection. 3,000 on its erection. The asset is expected. The asset is expected for 4 years, so the estimated life value is 4 years, after which its breakup value is estimated 5000. They are just assuming that after 4 years we can sell this asset or we can sell this machinery for rupees 5000, so basically it is a scrap value. Now, find out the amount of depreciation to be charged every year. Show how the machinery account would appear for the 4 years, assuming the machine is sold for rupees 1000 at the end. Now, it is the actual value. It is the actual value. We sold the machinery for 1000. Also, show the balance of machinery account would appear in balance sheet. Now, it's a full fledged question. Let's see. First, calculate the value of depreciation, annual depreciation. So the formula is annual depreciation, cost minus scrap value divided by the estimated years. Estimated years. So the cost is 22,000 plus 3,000 because we have purchased the machinery for 22,000 and spent 3 more thousand for its erection. So the value is 25,000, the cost is 25,000, and we have estimated the scrap value which is 5000. We are reducing the scrap value 5000 because in formula we reduce the scrap value, and we are dividing it by the estimated life, by its estimated life, which is 4 year, which is 4 years. So 25,000 minus 5000 is 20,000 and it will be divided as 4000. The amount come 5300. It's a misprint. It's a misprint. The depreciation will be 5000. When you divide 20,000 from 4 by 4, the amount will come 5000. It's a misprint. It's a misprint. The amount is 5000. So the amount of depreciation is 5000. Now taking it to the machinery account. First, when we have purchased the machinery, the entry would have been like machinery account debit to cash account or to bank account. So we are debiting the machinery account debit to bank account here. Amount 22,000. To cash account, it is erection charges. Machinery account debited to cash account. We have paid the erection charges, which is 3,000. Now, at the end of the year, 31st December, at the end of the year 31st December, we have put a depreciation because we have used this machinery the entire year from 1st January to 31st December, from 1st January to 31st December, and the depreciation is 5000. The depreciation is 5000. Now when we calculate, this side comes bigger. Okay, that it shows a debit balance 25,000 and 5,000. Now the balance here is 20,000. We will show it as like by balance carried down, by balance CD means balance carried down. Now we will transfer the same to the next year, and it will show a debit balance to balance brought down 20,000. Again, at the end of the year, we will put a depreciation on December 31st. The amount will remain same because it is an SLM method and the balance is 15,000. Again, we will brought it down in next year. The balance brought down is 15,000. Now, after the at the end of the year, we will put a depreciation, apply a depreciation of worth rupees 5,000 because it is an SLM method. So the balance here is remain 10,000. The value of the asset in December 2013, 2017, 13th December 2017 remains 10,000, and the same will be carried to or brought down to the year 2018. So the balance on January 1st, 2018 is 10,000. Again, at the end of the 2018, the depreciation is 5000. Now we have sold this. We have sold this machinery worth rupees 1000. Worth rupees 1000. So the entry could have been like bank account debit to machinery account. Bank account debit to machinery account. So we are crediting the machinery account here by bank. So the bank account is 1000. The remaining balance is 4000. The remaining balance is 4000, and this 4000 is a loss, is a kind of loss to us because we have estimated we have estimated 5,000 sale. Okay, and it we have sold it for rupees 1,000. So the remaining 4,000 is our loss. So this is how depreciation works. And one more thing I want to clear to you guys here, because we have purchased the machinery on January 1st, because we have purchased the machinery on January 1st, and the year is uh, January, and the accounting year is calculated here from January to December, we are applying the full year depreciation. Suppose we have purchased, suppose in this question we have purchased this machinery on May, 1st May, on 1st May. Now, now the depreciation will be calculated. Now the depreciation will be calculated for 8 years, for 8 months only, for 8 months only, because this depreciation is for 12 months. It is a annual depreciation. But now we have purchased it on May 1st. So the 4 months is gone. The 4 month is gone. There remains silent. So we have used this machinery only for the remaining 8 months. Now we have to put depreciation for 8 months only. In that case, we just put 5,000 into 8 by 12. 8 by 12. 5,000 into 8 by 12, and the value for 8 months will come. So that's how it works. And for today's class, I guess it's enough for today's class. In the next class, we will be doing diminishing balance method. So you need to practice depreciation as well. You need to practice depreciation as well. I hope it's clear.
Yes, ma'am.
Okay.
Yes.
Now you have an overview of diminishing value method as well. So you can practice it too. Okay, practice this too. But I will start in next class from the diminishing method. Okay. Till then, just keep your practice. Do practice of journals, ledgers, and trial balance. It's a must for you guys. Now I am concluding this session. Okay. The class is yours, sir. I'm just leaving.